Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. And before I begin, just want to say a very happy and prosperous new year ahead for all my subscribers, and to take this opportunity to say thank you for being my subscribers. It makes me very, very happy that people have come on board with me and watch my videos once a week. That obviously takes a lot of time, effort and energy to do so, and the patience. So a very big thank you to you. And in today's video, I'm going to be talking about all sorts of things today, to be honest with you, because it's a very confusing picture. Everybody seems to be talking about all sorts of things at the moment, and there isn't really a proper narrative as to where we need to focus on. And it's the first time really I've thought to myself, well, where do you begin? The fact of the matter is we've come to the end of the 4-year cycle and we've not had a blow off top. So obviously we're going to be getting an extended cycle this time. How extended it will be, to be perfectly honest, nobody's got a crystal ball and nobody really knows. So the question is, will it be anywhere between now and 3 months time, 6 months time, or is it going to take another full year? So we'll have a look at various scenarios, and I'll be looking at around about the 4 possibilities of where we could go to from where we are now. I'll also go through some trading levels. If you're a trader, you'll know those levels anyway, hopefully, but if you don't, then obviously I'll go through some of the areas where you could really trade at a profit as we move, hopefully, between where we are to where we think the market may be going, up to 52 or 58 or even 60,000. I won't have time to do a Wisdom Bites this week, but I'll do a special one next week. Considering that we're at the beginning of the year, I want to just share some of my thoughts of what I do at the beginning of every year to try and map out my goals, my objectives, my targets, and how to set them for the following 1 year, 5 year, 10 years. And for that, we need obviously a vision, a dream, etc., etc. So look out for the Wisdom Bite next week on that one. The idea behind it is that if you've been unhappy about how the last year has been, then unless you change and do something completely different, then your next year will be exactly the same. And if you look at your past 5 years, if you haven't been happy with the last 5 years, and certainly if your last 5 years have not been as you wanted it to go, then unless you change, then your next 5 years will be exactly the same. And the biggest change that normally comes around is when you start to actually focus on objectives and goals and targets. That's what really changes, because then you've got something concrete, a template to work on, where you can actually take action and make things differently going forward in comparison to what's happened in the past. So those types of things I'll be discussing in the next week's Wisdom Bite. So before I begin, the usual disclaimer, please remember I don't have a crystal ball. I'm not a financial advisor. Everything in this video should be used for educational purposes only. And I would always urge everybody to do their wider research before making any investment decisions. So with that out of the way, get yourself a cup of tea, sit yourself down, eyes on the screen, and let's get cracking. I'm actually going to start off with the 1 hour chart. I don't normally look at the 1 hour or the 4 hour charts in my videos anyway. I just wanted to point out that we're in this range between these levels here, between 46.5 and $48,000 here. Although I said in last week's video that if we get rejected at this level here, which we did at 52,000, and I pointed out that unless we get above 53,000 here, then this would be a sucker's rally. So I said be careful that this rally here could easily turn out to be a sucker's rally unless we get above 53. However, it did turn out to be a sucker's rally, and look what's happened. I certainly wasn't expecting such a big fall down here, but that's exactly what we got. And what this 52k rejection has culminated in is basically finding support at this level here. If we put a horizontal line here, we can see that this is where it's found support numerous times. Maybe if we go even further back, there, that's when we had that $42,000 fall. I have to say, at this point, it was Prozac time really. Everybody was really in depression, and there was a very big danger here, I thought, of falling towards the $40,000 mark. Thankfully, it didn't actually materialize, and that obviously is a bullish sign. But the thing is that it has to be confirmed by a strong rally to the upside, which we haven't got yet. The reason why I'm showing you these levels here with these white lines is that we're not out of the woods yet, because although we've had a bounce at this level here, we've made several attempts to break it, as we can see here. And certainly going back to the $42,000 mark is still on the table, which isn't some happy news, but this is how the market is panning out at the moment, and we've got to just be aware of it. And what we've got to do is, first of all, get above these levels here at 48,000, where we're currently range bound here. But so look out for a 4-hour close above the 48,200 level mark here. And that would be the first step. And then the second step would be to get above this very clean cut level that we've got here. As you can see from here, lots of resistance here, got resisted there, and here, and here. And then we've got support here. And that tells you that this is a very important level of resistance and support. And as traders will tell you, as soon as you see this kind of thing, these kinds of levels where they're very clean levels of support and resistance, they present an opportunity to trade, if that is what you want to do. For me, the trading opportunity would be if we can get above this $53,000 mark here. Once you get a close above the 53, then there'll be a very quick run up to the $59,000 mark here, where I would expect with a high degree of probability to be a rejection. So for me, it's better to be in a long position where we are in this range bound market here, to ride it all the way up to the 52, 53. And the way I would normally play with my trading portfolio, and I don't do a lot of trading, but when I run out of Snickers bars, I feel I need to do some trading. And if you look left from where this point is at 52, 53, you'll see why there's a very high degree of probability that we're going to get rejected at that point. You can see that this was a point of very strong support here. As soon as we came down to here, we had a big bounce there. Once again here, it used it as a support to have a big bounce to the upside. This was a point of resistance. As we came up here, we had a big fall to the downside from there. And going further back, you can see that it was chopping and changing along this line here. So very, very strong level of key resistance and support at the $53,000 mark here. And because we haven't attempted to come back and challenge this $53,000 mark, as we know, usually on the first attempt, there is a very high degree of probability that we'll get rejected. And it's usually between the third, fourth, or the fifth attempts that we actually see a breakthrough from key resistant levels. So I would expect with a high degree of probability for a rejection at 53,000. And the question is always then going to be, how far would it fall from the 52,000? This is where our Fibonacci retracement level comes in. So should we get up to the $53,000 mark, we have to measure from the bottom where we've just been a couple of days ago here to the $53,000 mark there, and down to our favorite level, which is the 61.8. So we're really looking at this level here, this pocket, the golden pocket of the 61.8 and the 65%. And that's going to be a fall back to 48.7 to 48.4,000, that range there. I'll change the color so that it's more visible. Is for the market price, as long as we can get above this level here, as I said, about 48,000, if we can make our move up to the $53,000 mark here, then there's a very strong probability of a rejection and the price to come back to this level here, around about the $48,500 mark, before we make a second attempt at the $53,000 mark here. And should we get through that, then the next level to be aware of is the $58,000-$59,000 mark here. And the reason why 58.59, there is a confluence with the Fibonacci retracement. When we look at the bigger picture, you'll see why the 58.59 is going to play a very big role. And certainly for me anyway, there will be a high degree of probability once again that we're going to get rejected here one more time before we make a further move up from there. So if we zoom out to the weekly chart, you'll see why the 58.59 is a very important and relevant level for us to be aware of. Take the Fibonacci retracement from here at the top to the recent bottom, and there you have it. You've got the 61.8 to the 65% golden pocket level exactly on this level here at the 58,000 to 59,600. So you've got to be aware of this, that this is more than likely going to play out. Obviously, we've got a long way to go there, but we must always look ahead and know where the levels are, especially if you're trading. And if you want even more confirmation why this is a very high degree of probability move here to the 58.59, just look left and do the same thing from the previous high and the previous lows. So you take the Fibonacci retracement from this top here at 65 to the lows that we got here, and look where we came up to before we got the rejection at exactly the 61.8 and 65% golden pocket. So these things are going to be playing out over and over again. And this level was at 52,000, and hence we've got these levels here, 52.53 and then the 58.59. Extremely important levels for this pattern that's developed over the last 8 to 10 months. So just looking at a general market summary of exactly what's been happening in the last 8 to 10 months here, it's quite clear that in the recent past, since we got the all-time high back here in November, the bears have definitely been in control here. And what we're really looking for is to create higher highs and higher lows in this direction here, obviously, to give us some confirmation of a bottoming out and a reversal from these levels here. And on the larger term time frame, we have this at the moment. We've got the higher high here from these levels and another higher high there. And as I pointed out before as well, the higher lows here. So in all honesty, this is still a bullish chart on the higher time frames. And if we have a look at the daily chart, there is one moving average which is proving quite important, and that is the 34 exponential moving average. And as we saw from the October rally that started in 2020, we've been finding support numerous occasions on the 34. But once we fell down, it got rejected back here, and since then it got rejected several times here and acted as a resistance. In fact, I'll change that to a different color because it's looking a little bit messy. There you go. But when we managed to get above it, it provided support once more here, and again resistance down here. But as you can see, it's been chopping and changing since then, and currently we find ourselves below it once more and finding it very difficult to get above it. So the first point of call really is to get above this 34 exponential moving average, which is currently at 50,000. And as long as we're below 50,000, the price action is looking very, very bearish. And if we have a look at the simple moving averages on the weekly chart, the one that we've really got to be aware of is the white line here, which is the 50 simple moving average. And we've just been chopping along it at the moment. We keep going below and above it. And currently we find ourselves below it again. And that's not really a good sign, because we really want to get above the 21 weekly, which is the yellow line here. That's traditionally the one that we would look at to tell us that we're back in the bullish side of the market. And that level is currently at 52,600. And if we do find ourselves falling out of this range here, then I'm afraid the next point of support will be the 100 simple moving average here, which we haven't fallen down to since the COVID-19 situation. If you look back here, that was the last time we fell to this level here. So that's well over a year and a half ago now. So only time will tell. And obviously the 200 moving average here is the one that should come in play in the following bear market. So we must keep our eye on this for the longer term. Certainly I'm not expecting it to come down to these levels at this point in time, but we must keep this up our sleeve for the next bear market, because this has always proved to be the most profitable point of actually accumulating Bitcoin and the altcoins. If you go back in history, you'll see these were the best points, and you can go much further than that, as I've shown you many times in the past. These are the best points, so we must keep this green line, the 200 simple moving average, on our radar at all times. But first we must recapture the 50 weekly moving average here, and then the 21 weekly moving average there. I'm actually going to cover now something that answers a question which I get repeatedly asked between diagonal trend lines and horizontal trend lines. And people usually ask me, why do you tend to draw mostly horizontal trend lines? And what's the difference between that and the diagonal trend lines? It's a very simple answer, and that is, firstly, In classical charting, diagonal trend lines like this here, which have got so many points, and this looks, for all intents and purposes, very, very strong. And look, it's even broken out on the diagonal trend line, come back as support, and then we should be good to go up. However, if you're a trader, then you should know that you must never put a trade in here at the break of this trend line, because you have to take a two-pronged attack when trading. And that is, this is the first break, the diagonal line, which is not as important and relevant as the horizontal trend lines, simply because when you get this, until it breaks a horizontal support and resistance line like here, this will generally turn out to be a fake out, which is exactly what's happened here. So when we have a breaking of the diagonal trend line, that's the first tick, but we must always have two ticks before trading, and that is, we must break the horizontal support and resistance line, which is over here. And if you zoom out like on a daily or a weekly chart, you can see them quite clearly that before you could get a trade in here, i.e. a candle closing on a 4-hour or a daily time frame above this level here, it's at that point you would be thinking of taking a trade here to the upside. And if you want to really be cautious, you'd wait for a candle and then the throwback to these levels again, i.e. a retest of the old resistance point as a support, and then take the trade upwards from there. So always remember, the diagonal trend lines are not as important and relevant as the horizontal support and resistance. And that's why I've got them at these levels here. You can see the next level is obviously up here, and that goes corresponding to back to these levels over here. So this is quite clear that at the $58,000, $59,000 mark here is the next levels. And that would go back to these levels here. And if we look at the bump and run pattern that we've been looking at for the last few weeks, you can see that we've got a diagonal trend line here. But certainly we need to move above this level here straight away here at the $52,000 mark first, where it's come up to there. And then we need to clear this $58,000, $59,000 mark. So again, we use the diagonal trend lines as the first step, and then use the horizontal support and resistance as the confirmation and the second step before we know where the trend is now moving to. And certainly by looking at this bump and run, or cup and handle, whichever way you want to look at it, because it's certainly a cup and handle here as well. And then we've gone back up above this diagonal trend line. And the beauty about this is that we've come back and found resistance and support exactly on this trend line. So this would look extremely bullish to the upside, and yet people were on the Prozacs down here. For me, there's too much chopping around going on here at the $45,000 to $50,000 mark. We really need to get above the 50K to give us a bit of relief, a sigh of relief from this negative sentiment that we've all got down here. But as traders and investors, we have to really remain neutral, and it shouldn't affect our long-term positions until we close below the 39,600 level. And the current negative sentiment, in a way, is a very good contrarian point of view. And if we have a look at the Fear and Greed Index, just yesterday, after the fall the day before, down to 45, we'd gone to extreme fear. And that, as I showed you last week, is one of the ways of actually picking up the cheapest Bitcoins or altcoins, because it's at those points where you get the best prices, around about the 15 to 20 Fear and Greed Index levels. But we've now got up a little bit higher to 29 currently to today. So we're still hovering in these low levels here. And as I showed you last week, these are the best points as to when to pick up the cheapest dollar cost average coins. But the main thing is to just be patient and let the process resolve itself before taking a position. And being neutral seems like a fair position to take at the moment. So the four scenarios that I see going forward in the next few months are these. Firstly, the least likely, which is this, that if we fall below these levels here at 28,800, So if the price goes below this now, then what this becomes here is a double top. Then we're in a bear market once we clear these levels at 28,800. As I said, I'm not expecting that. This is the least likely scenario, but it's definitely on the table as a possibility, even though it's a remote possibility. And I can tell you that if this did happen, it would be a complete disaster, not just for Bitcoin, but for the whole of the crypto market. There'd be a massive loss of confidence in this space. And it would take a long time for it to regain it back again. This is a critical level, and I'm not expecting it to break for that reason. The second scenario is basically the rectangular approach, which is basically if you take the tops to the bodies of the candles here, that would give us a range-bound market. And again, that would require, really, for all intents and purposes, to revisit this area here down to around the $30,000 mark here before we move to the upside and look at what it creates here, a W double bottom pattern. Once again, it's a low probability scenario, but certainly one that's even more on the table than breaking the $30,000 mark. So we could quite easily shake out a lot of people here before we make that final move to the upside. The third scenario that I can see is this ascending triangle here. And if we don't bounce off these levels here to the upside and we break down below this resistance point, then the next level is going to be here at 39,600. So it may well be that we visit this 39,600, which is my red line in the sand. And as long as we don't break through to the bottom side, we should still hold our nerve at this point to take it back up. But this will be a very difficult point to hold our nerve at, and certainly Prozac sales will be going through the roof at this point. But what I would expect here is that a capitulation would really take place all the way down to these levels here at 28,000. So once we break this here, this is what I'm expecting, a very big fall very quickly, a little bit like this here. And the fourth scenario is the cup and handle that we've got here. But we can actually rechange these lines and make it into a cup and handle here. So what we then get is, instead of this being a cup and handle, but we get a larger cup and handle that we've just made with the handle here. And this would tell us that we've now bottomed out at these levels and we're now ready to go back up. The reason why I favor this scenario is that I have to go back to my favorite indicator, which is the hash ribbons. When we got the buy signal of the hash ribbons at 43.5, 44,000, that told me that it's very unlikely that we're going to close below, on a daily chart at least, below those levels at 43, 44. And when we came down here, that was the only thing I was looking at, thinking that surely it's not going to break down below 45. And it held strongly here, which was very bullish for me. So this is why this is the most likely scenario. Obviously, I could be wrong. I don't have a crystal ball. Everybody has to make their own assessments. But there's a lot of doom and gloomsters out there, who are looking for, these prices down here, $17,000, $18,000 around here. And of course, I respect everybody's opinion, because who knows who's going to be right? And they could well be right. The probability is very low as far as I can see. And for me, I always let the market make my decision. So I'm always willing to hold my nerve and let the market make my decision. And my decision will be based on this level here at the 39,600 level. And finally, we just need to keep our eye on the general market out there, the Dow Jones, the junk bond market, etc., and the dollar. I'm expecting, like a lot of people, for a big market crash in 2022. And whether that's going to come in the first quarter, second quarter, or towards the end of the year, only time will tell. But we've got our indicators, which we're keeping our eye on, to give us the first signs that that crash is about to happen. And the main one I look at is always the junk bond market. And I've drawn for you for the last many months now these two levels. And we were basically coming to a very concerning position down here. But since then, we've jumped up quite bullishly up here. So it looks to me as though that it's not an imminent crash that's on its way. So currently it's at 87. And I will start getting concerned if it falls below 85. and my red line in the sand is at 83. If we break 83, then basically the Dow Jones will be following suit with a big massive correction after that. And if we have a look at the Dow Jones, you can see quite clearly that we've bounced off from this long-term trend line, as I've shown you for many, many times now, which stretches back all the way back to the 1800s. And the levels to look out for, so we're above it here at the moment, so we know that a crash is on its way. But certainly the two levels to look out for is this first red zone here, which we're very far from currently. But this would be very, very concerning if we fell to this level here, to the red zone. So that will be my pre-warning at around about 33,700, around those levels. And if it falls below 33,000 on this green ray here, then that's my red line in the sand. So again, it doesn't look imminent in any stretch of the imagination here. But certainly it will be chopping up and down here. But these are the levels to look out for. This first red zone here at 33,700 and the green ray here at 33,000. A quick look at the dollar. And I've been saying for the last few weeks that if you look at the dollar and you look at the RSI, you can tell it's overbought, and that I would be expecting a fall from these levels here. And this is exactly what we're getting currently. We can see that it seems to have a topping out pattern here, and we're now on our way down. And if we did the Fibonacci retracement from the previous high here, we can see that it's getting rejected at the 50% level. It's still a possibility to get up to the 61.8. Fall below the 70 level here on the RSI tells me that it's not going to do that. Of course, it can turn around, but there is a lot of selling pressure here with this RSI falling below the 70 level. It's currently at 61.55. This should give some room for Bitcoin to grow to the upside. What I'm expecting is for the dollar to come back down to the 61.8 zone here, which is around about the 91, 92 level from its current 95. So this is where I'm expecting a pullback down to before it starts moving to the upside again. So only time will tell, but certainly it's looking reasonably okay from Bitcoin's point of view, that we seem to have topped out on the dollar, which has an inverse relationship with Bitcoin and the general markets. Okay, so we'll leave it there. I hope you found some value in that. It's been a little bit bitty simply because there's a very big confusing picture out there. And we're all waiting for Bitcoin to give us some direction as to where it wants to go. So hopefully by this time next week, we'll have a little bit more clarity in that sense. Okay, so I hope you found some value in that. And if you did, then please do remember to like and subscribe if you haven't already done so. And if you've got any comments, questions or suggestions, then leave them in the comments below. Until the next time, take care, stay safe, and I'll see you in the next video. Bye for now.